Good morning, Mr. Bearden. Thank you for taking the time out of your day. You got a busy schedule to meet with me and answer a few questions.
Sure.
Could we start this off by you telling me what you do and where you work and stuff like that?
Yeah, so I'm a certified financial planner, and I work for PNC Investments, and my office is in Beechwood, Ohio.
Okay. How long you been doing that for?
This is actually my 13th year in the business. So I graduated from the University of Toledo December 2006, and started working in financial services shortly thereafter, within a couple of weeks.
So would you major in economics or finance or something like that, or?
Yeah, so I actually started off as a business administration major, like I think a lot of freshmen do, and I was fortunate enough that I had a principal of macroeconomics class that was actually taught by the chair of the econ department at Toledo. And usually it's like a TA, but the chair of the department was the teacher, and it was probably one of the best classes that I'd had. So I took another economics class, and then like 2 years in, I realized that I had already taken like 5 or 6 econ classes, and in meeting with my advisor, it just made more sense for me to transition to become an economics major.
That's nice. Is this something that you obviously didn't plan out your freshman year or going into college? When did you make that decision? Was it your junior year, sophomore year, or just automatic?
So going into college, I wanted to work primarily as an equity analyst. Like, I thought it would be cool to do valuations of different companies and so forth, maybe go work for a hedge fund. But it was probably my junior year I met a mentor, and he was in the financial services industry, and he thought that I would be better served
Mm.
working with individual clients and so forth rather than kind of positioning myself behind a bunch of computer screens and doing just technical analysis all day.
Mm-hmm.
So
Yeah, it makes sense. So, as someone like me that's an undergrad getting ready to graduate in the next couple of years, how would you, what would you recommend for someone like me to do to start planning for the future? Should I open up a savings account and just keep on putting money into there and incurring interest in that, or take some more riskier type of investments?
yeah, no, I think generally speaking, the number one rule of financial planning is always to secure yourself an emergency fund. And a typical emergency fund is going to be anywhere between 3 to 6 months worth of your living expenses. So, and for new graduates, this is really important because if you compute that your living expenses come out to be, $2,000 per month, then you want to make sure that you have a savings account that's adequate to support that. Maybe somewhere between $6,000 to $12,000 in total balance. So that's certainly the number one rule of financial planning. I think as a young person who's getting ready to start off and kind of enter the real world, I would say the number one rule, just in general, not necessarily financial planning oriented, but the number one rule in general, and my best piece of advice is to make sure that you live within your means.
Mm-hmm.
So I think that too many people oftentimes spread themselves too thin, right? They take on too big of an obligation for rent or for their mortgage and whatnot. They take out car loans and so forth, and then they don't have any sort of income at the end of the month to be able to save for that emergency fund or to be able to put away for retirement savings and so forth. So I think that the number one financial planning rule for somebody in your position is to make sure that you have an emergency fund set up. But I think the number one rule in general is to make sure that you live within your means. Don't let your rent, don't let your mortgage exceed more than 25% of your net, not your gross, but your net earnings on a monthly basis.
Okay, and that goes into budgeting, which is something else I want to touch on. So, have you ever budgeted? Do you still budget? Did you used to budget? And when you did, if so, how did you go about that? Did you have basically a percentage as you brought up for the rent? And
Yeah, no. So if I'm being honest, when I was a young person or younger, I didn't budget, and I found myself like, not saving as much as I wanted to because I was just kind of like in the moment. I
mm-hmm.
wasn't taking control of my finances. And then as I got more mature and as I learned to respect money a little bit more, I started becoming very particular with my budget. Um, I'm at the point in my life now where I have, 2 daughters and a couple of different properties and so forth. And, my one daughter goes to, private school. So it's important that I always know kind of what my financial situation looks like on a monthly basis. So I'm pretty strict with budget today, and I think that most people who've had professional success or at least financial success also, live with a budget and they manage their budget pretty closely.
Okay. Speaking of that, for planning for the future and going along, make sure you're budgeting and you're setting that money aside. As long as it comes to investing,
Mm-hmm.
what do you think is usually the best way to go about that? Would it be basically opening up a brokerage account or having someone else manage it for you, or buying into an index fund,
Mm-hmm.
kind of diversifying your portfolio?
Yeah, so I think that for a younger person or a person just starting off in the real world, if you will, I think that company or employer-sponsored retirement plans are huge. Most of them usually offer matching funds, which in layman's terms is free money, right? And most of those company-sponsored plans, they are automatic deductions from your gross income. So you never have to worry about mailing in a check to a mutual fund family or a brokerage account company or anything like that. It's done automatically for you. So I think that the easiest way to get started as an investor is to put money away into an employer-sponsored fund, assuming that your employer offers those types of accounts for you. When you do put money away into there, you can put money usually into a pre-tax bucket or a Roth tax-free bucket. As a younger person, when you have 20, 30, 40 years until retirement, you're going to find that the incentives of putting money away into a tax-free or a Roth bucket makes a heck of a lot of sense when you start compounding your interest over a long number of years. It's going to give you a lot of tax-free growth, which will be a huge advantage for you when you get to retirement. I think in terms of the vehicle that you choose, index funds are a great option. There's virtually no management expenses that go along with the index fund themselves. So owning an S&P 500 index fund makes a lot of sense. You're basically just buying a share of the entire stock market. Or a lot of company-sponsored, retirement plans offer what we call target date mutual funds. And these are very simple to administer investment accounts where the allocation of the fund itself changes its risk composition almost every single year. So while you're just starting off and you've got 30, 40 years until retirement, the portfolio itself is very heavy in equities, very heavy in stocks. It's going to, almost mirror an S&P 500 index fund. And then as you gradually get closer to retirement every single year, it will sell some of the stock positions and it'll reinvest those proceeds into fixed income bond positions, which traditionally are more conservative and they don't have as much volatility to them. And so through that automatic composition change, you're in a position as an investor that you don't have to make these decisions on your own. So if finance or investing, if it's not something that you have a really strong technical knowledge of, you're not jeopardizing your future by not, reallocating or repositioning your portfolio as time progresses. The fund is doing that for you itself.
Okay, so in short terms, when you're young, you want to invest more in stocks and things like that, which more volatile, which will hopefully recover. And then as you get close to retirement, more bonds and things of that nature, a little more safer.
Yeah. So, stocks generally speaking have the most upside potential, so they're going to have the most growth potential. But understand that stocks, generally speaking, are going to have more volatility, more of a roller coaster type effect to them versus bonds or cash positions, fixed income, less volatility to your return, less total return potential though. So a very common mistake that a lot of investors make is they say, well, I want to go with the safe investments. And Rule of 72 says, if I'm only earning, say, 2 or 3% on an individual, investment position, it's going to take anywhere from 36 to 22 years for my money to double. Whereas if I'm in a stock position or a stock-based index fund, and I average, say, 7 to 7.5% return on my money, it only takes 10 years for my money to double. Okay, so generally speaking, you're correct. The younger you are, the more exposure you want to have to growth-oriented investments or your equity positions, your stocks. And the older that you get, usually you want to kind of sell off some of those stock positions and now it's not as much I want to make as much as possible. It becomes more I want to kind of protect my money a little bit more. That becomes more of your primary focus.
Okay, that makes sense. And just to dial it back, not so much in the future. So, say for purchases that an undergrad would want to make
Mm-hmm.
in the next 3 to 7 years, whether it be buying a car or financing a house, renting an apartment,
Mm-hmm.
anything of that nature, any major first life purchases that undergrads are going to make, what do you think the best way would be to go about that? Just live on your means right now and save it, or
Yeah, definitely. I mean, live within your means at all times. I'm not a huge fan of renting anything. I'm not a huge fan of financing an automobile because, generally speaking, it's an asset that loses about 20% of its value every single year. And so a lot of people then finance that investment, right? They pay interest for the opportunity to lose money, right? So that's kind of crazy, but unfortunately, it is a use asset, so we need it. So I think when it comes to vehicles, my advice there would be, don't go after the big, brand new, shiny, newest vehicle. Go after the one that's maybe a year or two old, right? And there's a little bit of depreciation already built in there. You can usually find yourself a better deal. When it comes to housing and so forth, again, I'm not a huge fan of renting, but oftentimes if you rent an apartment or a house or something and you have a few roommates in there, you can keep your costs lower, therefore enabling yourself to build up more of that emergency fund for yourself, or as you had said, maybe build up a down payment towards the purchase of a home. I think that it's really important to look at today's current market environment. Money's never been cheaper to borrow, right? So if a person is getting ready to leave school today and they have student loan debt, you may want to look at consolidating those loans together into one single payment because that might be a little bit easier for your budget. But in addition, locking in the interest rate at today's interest rates, because a lot of student loans I've seen in the past, they have variable rates. So when rates are low, the interest itself is lower, but as rates start to go up over time, which they will, right? It's probably not going to happen in the next 12 to 24 months, but when rates do start to go up again, that means your interest expense for carrying that student loan goes up. And similarly, it's kind of the same thing when we talk about the housing market, right? There's a lot of programs out there that don't require a tremendously large down payment amount. You can get an FHA mortgage today for only 3.5% down. So if you buy a property that has $100,000 price tag, that means you've got to come to the table with $3,500. Now understand though, in buying that house, you also have to factor in upgrades that you'll be responsible for and making on that home. So if you find a $100,000 house and it needs a $5,000 roof right away, or it needs a $3,000 or $4,000 HVAC unit, it's not just the $3,500 that you have to come up with. It's also the $5,000 for the roof, the $3,500 for the HVAC unit. So owning a home certainly is more of an investment up front, but generally speaking, real estate's an appreciating asset, and it's something that you'll usually get most of your money that you put into the home back out when you do go to sell the property in the future.
okay, that makes a lot of sense. So, kind of stick away from renting. I mean, maybe for long periods of time,
Mm-hmm.
you don't want to rent anything out. Make sure you save up for your house.
And renting, as a young person, it does give you flexibility. It's easier to break a lease if a job opportunity comes up out of state versus putting a for sale sign in your front yard and being dependent on finding a buyer. So when I was a young person and I just graduated, I rented for a few years, but I'm 36 years old today. I own 3 properties, and I think I've owned 6 properties since the age of like 25, 26. So I think that early on, renting, keeping that payment lower, maybe having a roommate or 2 roommates to really keep your cost a little bit, suppressed, and giving yourself more opportunity to build up your emergency funds and your down payment and so forth. I think that makes a lot of sense. But I think that, when you get a little bit of stability with your job and you realize, hey, I'm going to be here in this area or I'm going to be in this job for an extended period of time, I think at that point it probably makes a lot of sense to have strong consideration for buying.
Okay. And just to finish this up, is there any other um, advice that you would give out to someone in my position, or you think you covered up most of it?
Yeah, kind of in summary, the most important thing: live within your means. Second, I would say establish that emergency fund, and then third, when you do get that job, when you do finish school, if your employer offers an employer-sponsored retirement plan, make sure you're participating in it. And one piece of advice that I give my clients when they are participating in the employer-sponsored plans is, don't forget to increase your savings, whether it's every 6 months or once a year, in that plan. Because I think a lot of people, they sort of sign up for these plans and they put 5% of their income in here and then they never change it again. And while their income does go up over time, so that 5% technically is an increase, most people see on average about a 3% wage increase on an annual basis. So the general rule of thumb that I offer to clients is about every 6 months, increase your retirement contribution by about 1%, right? So if I get a 3% raise this year, but I increase my contributions every 6 months, that means I put 2 additional% away into my retirement savings, and I saw a 1% increase in my standard of living, right? So you're still increasing your standard of living a little bit, but you're also putting away more money for the future. And I would definitely say the best piece of advice, or the best kind of slogan that I can give to any young person starting off is, it's better to have time than money, right? Understand, Rome wasn't built in a day. Nobody's going to become a millionaire within a short period of time. But if you're consistent with your behaviors, if you respect finance, if you respect money, and you just follow the very, very basic rules, you're going to be successful when it comes to accumulating your asset base and growing your asset base. And whatever that means for you, whether it means retiring at 45, retiring at 55, retiring with $1 million or $2 million or whatever, follow consistent rules. Don't try to stay away from chasing fads, and try to stay away with keeping up with the Joneses. And I think that you'll be in pretty good shape.
Okay. Well, thank you so much for meeting with me.
Happy to.
Have a great rest of your day.
Thanks.